Hello, my name is Dan Hirschovits. I'm a partner in the Securities and Capital Markets Practice Group here in Paul Hastings' London office.
Hello, my name is James Lansdown. I'm a Senior Associate in the Securities and Capital Markets Practice Group here in Paul Hastings' London office. Welcome to this 4-part video series where we will provide a series of insights for UK commercial companies considering listing on the main market of the London Stock Exchange. In the second video in this series, we provide a high-level overview of the IPO process for a UK commercial company seeking admission to the main market of the London Stock Exchange. A UK IPO typically takes many months of preparation before the formal execution timetable even begins. Some elements, particularly the FCA's review of the prospectus, cannot be accelerated. From the organisational meeting that kicks off the formal IPO project to completion and listing on the LSE, companies should expect at least 5 months, often preceded by many months of extensive groundwork with lawyers and accountants to prepare the business for listed company requirements. The formal process begins with the appointment of the broader advisory team that we covered in our first video. The underwriting banks and sponsor, the legal advisors to the company and the banks, the reporting accountants, the registrar, and, if relevant, an independent financial advisor. During this initial phase, the company and the investment banks refine the structure of the IPO, whether it will target institutional or retail investors, how much capital will be raised, the mix of primary and secondary shares, and the overall timetable. Legal, commercial, and financial due diligence also begins, forming the foundation for much of the public disclosure required in the company's prospectus. Following this introductory phase, meetings are conducted with potential investors, known as early look meetings. These sessions are held privately to introduce the business and its strategy, but do not seek price feedback or commitments. Their purpose is simply to help familiarise public market investors with the company and its story ahead of the formal launch of the offering. Work then begins on drafting the prospectus, which must be submitted to and reviewed by the FCA. This document must provide investors with all information necessary to assess the company's assets, liabilities, financial position, prospects, and the rights attached to the company's shares. It must include 3 years of audited financial statements, any required interim financial numbers, detailed business and industry disclosures, and risk factors. Preparing historical financial information can be particularly complex where acquisitions, carve-outs, or reorganisations have taken place during the track record period, and thought should be given to any implications of such circumstances ahead of beginning the drafting process. The prospectus must also confirm the company's working capital position for at least a 12-month period after publication. Extensive financial due diligence by the banks and reporting accountants underpins this confirmation. Dan.
Thanks, James. Once a substantially complete draft of the prospectus is submitted, the FCA reviews it over several rounds of comment and feedback, and a statutory review period applies. The FCA also assesses the company's eligibility to be listed and often asks detailed questions, particularly where the company has a complex financial history, concentrated ownership, or an alternative share structure. During the FCA review period, the company typically conducts analyst education, which involves research analysts from the underwriting banks receiving a briefing so they can prepare independent research on the company for investors. Where connected analysts are involved, strict regulatory controls govern the timing and distribution of their research and publication of the company's offering documents. Responsibility for the prospectus carries significant legal weight. Directors, incoming directors, the company, and the banks may face liability if investors rely on inaccurate or misleading information. As a result, an extensive legal due diligence exercise is conducted to review and assess information about the company and its business. In addition, a verification process of key material statements is undertaken to confirm the accuracy of the information disclosed in the prospectus. Reporting accountants also provide comfort letters to the banks that support the financial disclosures. Once the FCA confirms it has no further comments on the prospectus and pre-deal investor education is complete, the company launches its roadshow. At roadshow meetings, management present the equity story to investors, and the investment banks build the order book for the IPO. Some transactions secure cornerstone or anchor orders from key investors ahead of public launch to build momentum, and offering some form of retail participation in an IPO is increasingly common. At the end of the roadshow, demand is assessed, allocations are agreed, and the offer price is set by the company in consultation with the banks. Underwriters typically go on risk at this stage, which is usually around 3 business days before completion. The FCA and LSE then issue their final approvals, and the company shares begin unconditional trading on the LSE. A stabilisation period typically follows, during which the banks may take certain steps to manage any downward price pressure on the share price in a 30-day period after the IPO. We hope you have found this video useful. If you would like to discuss anything covered in the video, or want to discuss a proposed UK IPO, planning for one, or any other type of capital raising, please feel free to get in touch with us. Thank you for watching.